For every new dollar that the government borrows, an estimated 66 cents of that dollar is going to have to go to pay the interest on that new debt.
That is absolutely insane.
It's shocking.
It's not even going to effective use.
I have no words for this, Charlie. The $18 trillion debt wall and the debasement trade. This is the theme we'll be talking about on today's episode of the Bullion Standard Podcast. Ladies and gentlemen, welcome. Thank you again for joining us here. Charlie, today is Thursday, I believe February 11th, 2026. This episode will be released.
Sorry, it's the 12th today.
Oh, February 12th. Okay. This episode will be released Saturday, February 13th, 2026, in 2 days from now. So it will be a bit of a timely episode. We're trying our best to keep the topics fresh and have timely uploads for our episodes here. We hope you're doing absolutely fantastic out there. If you have any questions or comments before we kick it off here, please leave them down below. We'd absolutely love to respond to you. We appreciate each and every one of you being here. Thank you so much for joining us. And Charlie, how are you doing today?
I'm doing fantastic. Just plugging along on all the projects, and just really excited to dig into a few new news items that have happened, and also, kind of review again where we're at with gold and silver.
Things are moving rapidly. They have been for the past 2 years now. Instead of going like this, we've been going like this. And so when things are going like this, as opposed to this, things become very interesting in the precious metals market, specifically for gold and silver, because this is not good for gold and silver, but when things start doing this, it's very good for gold and silver. And so, we've said many times, we buy gold, we own gold. We don't want the price to go up. We don't want nuclear holocaust. We own gold as an insurance policy. So today we're going to be talking about this $18 trillion of negative yielding debt and this debasement trade that seems to be the theme going into 2026. We've kind of mentioned a little bit about this on prior episodes, but let's really dive into it today. And I'm going to fire us off with a little bit of something I like to call a Rick ruleism. Rick, if you're watching this, we love you. Thank you for the inspiration here behind what we're about to talk about. So let's start off by talking about a couple of themes. We've mentioned these before. Let's talk about negative real interest rates. A negative real interest rate is an interest rate that is less than the prevailing inflation rate, i.e. if you buy a bond or an investment that has an interest rate that's less than the rate of inflation, that would be guaranteeing yourself a negative real yield, i.e. you will lose money. 100% guarantee.
You will lose purchasing power. The nominal value of your asset will stay the same.
That's right. You'll be paid the nominal value, but the real value when we account for inflation will be negative. This has been one of the very large drivers why people have piled into gold, one of them among a whole host of different reasons. Because there's an opportunity cost when you're yielding negative on your bonds or on your investments.
Should we talk broadly speaking about what an ounce of gold would have bought you way back when, and what it will buy you today?
I know the answer to that question. The answer to the question is an ounce of gold will buy you exactly the same baskets of goods and services all throughout history. 5,000 BC.
Averaged out, of course.
1,000 BC, 950 AD, the year 1850, 1933, and all the way forward in 2026. Gold stays constant. Money around us is what changes values. This is the nature of fiat currencies. This is why gold has gone from $35 to $5,600 in the past 50 years about. So,
and we should also clarify that, there's, allocations of gold that are higher and lower when the volatility peaks. And, so then you'll have these arbitrage opportunities where you can, get out of a fiat currency, get into precious metals, and you'll gap up in your actual purchasing power. So when we're talking about the basket of goods and services that an ounce of gold would buy 1,000 years ago and 500 years ago and 200 years ago, I mean, you got to average that out. You got to average it out over time for it to actually make sense.
U.S. public debt has officially blasted through $38 trillion. That's a 38 with 12 zeros. It's a very big number. I can't think about how big, I can't think about the enormity behind this number. It is truly behemoth. I don't think there's any visual representation we could put behind this as far as $100 bills go. We're talking really big structures, bigger than skyscrapers. We've kind of mentioned that before, but this debasement trade, think about all the money, Charlie, that is out there in negative yielding debt right now. So let's think about university endowments. Let's think about the bond portfolios of very large insurance companies. Let's think about the debt holdings of sovereign wealth funds.
Other nations.
Let's think about all the U.S. treasuries that are negative yielding. Even though the market has kind of fixed that and the value of those bonds have gone down to accommodate that with higher yields, that only applies when you go to make a new purchase or if you, roll over your bond into a higher yielding bond. But also, in a separate apart from that, we have the fact that there is a $2 to $2.5 trillion per year deficit right now in the United States. $2.5 trillion per year. Where's this money going to come from, Charlie?
Well, you got to tax the rich.
Did you know that if we confiscated, not taxed, but confiscated, stole 100% of every billionaire's net worth, it wouldn't solve the problem? Are you aware of this?
I am.
So when we talk about taxing the rich, I really don't have a good idea of what that means. Because,
okay. So then we got to cut spending.
Correct. We're spending beyond our means. We have an unserviceable deficit, and this is something that's been going on for as long as we've had this grand fiat money experiment, since gold has been disconnected as a form of real money.
Can we talk about how, I can't remember the name of the website. There's a website that's tracking the amount of money flight from California right now because of the potential wealth tax, like the gross value tax, where you get taxed 5% on whatever the gross is of your holdings. Something like $30-something thousand a minute. That's the amount of money that's that has been leaving California. It's really interesting. So it doesn't work to tax the rich. Why? Because the rich take their money to the place where it's more ideal. And so, there's always going to be the possibility that, going way back when, before there was airplanes, gold got loaded up on ships and it sailed the 7 seas. And so that's going to happen. So there's only so much taxing that you can do before you reach that tipping point where, people decide to, vote with their feet and leave and take their gold with them.
For every new dollar that the government borrows, an estimated today, in February 2026, an estimated 66 cents of that dollar is going to have to go to pay the interest on that new debt.
That is actually something worth repeating right now, Kyle. That is absolutely insane.
Let me say this again. The interest spiral is specifically what I'm talking about. For every new dollar the federal government borrows, from this point going forward.
So money that they're not collecting tax revenues on, it's money that they're printing
today, new dollars.
That they're issuing new debt. I don't think we're QE heavy right now, but they're issuing you new debt and borrowing. They're issuing bills, bonds, and they're saying, please loan us your money. And out of every dollar that they borrow, 66 cents of that goes towards paying prior debts.
It's shocking.
It's not even going to effective use.
It's I have no words for this, Charlie.
Wow.
And it begs to ask the question, so what has been the theme, as we just kind of talked about, with people who hold treasuries? Well, they've been abandoning them. They've been selling their treasuries in favor of gold because there is an opportunity cost to hold treasuries when you're getting paid a guaranteed real loss. Guaranteed real loss. If I told you, Charlie, here's a note, and I'm going to pay you back less in the future than you're giving me today, what would you say to me? Would you say, that sounds like a great deal? Or would you say, you know what? There is actually a bit of an opportunity cost here. I'm actually just going to chill out in gold
Not
for a
interested
while.
in losing money. Not interested in letting a certain percentage of my stored energy and exertion and work just evaporate. Just 2-3% a year, 4%, 5% a year. Man, it's pretty significant.
One of the other Rick ruleisms we'll talk about quickly is the total aggregate debt of the United States. I think he calls this the math of America, which I find interesting. Let's think about off-balance sheet liabilities. Let's think about entitlement benefits like Social Security, Medicare, Medicaid, military pensions. All money that is not on balance sheet on the U.S. federal debt, national debt, that will have to be paid for future entitlements and obligations. We'll call it off-balance sheet liabilities.
So this is all the projections on what it will cost the government to fund all the programs.
Yes.
In the future.
There's an interesting, very elementary thing in finance called the time value of money. And so in finance, we'll do something called a net present value calculation. This is where we have a series of cash flows and then a terminal value, which accounts for all future values. And then we can discount those cash flows or those years or those periods back to the present at a discount rate or the prevailing interest rate or hurdle rate or whatever rate you want to use. But today we would use probably the 10-year treasury is a very reliable rate to use. If we took the net present value, according to the Congressional Budget Office, of all off-balance sheet liabilities, we would need to have something like $120 trillion. $120 trillion to reinvest at today's interest rate to be able to service our future obligations.
So what we could say is if the United States of America created an endowment, that endowment would have to be funded with $120 trillion in order to have it pay for the operation of just the entitlements in the government moving forward.
Correct. So something interesting we mentioned too that happened back in the bear market of 2022 is that usually treasuries have been this flight to safety trade. When things get crazy out there, people find shelter in treasuries. Why? They're a very stable asset. The value goes up. Why is that? People pile into them. It's always been this safe haven. When there's a positive real yield, when there's a negative real yield, and we harass the public by printing fake CPI numbers instead of calculating the true rate of inflation, how we've historically calculated it, people lose a little bit of trust in that system.
When you say harass, what do you mean?
Charlie, if I were the government and I said, this is the official rate of currency devaluation, aka the CPI, aka inflation, and you said, that doesn't quite match what I'm noticing here on the ground out in the real world. I'm actually noticing something like a tripling or a quadrupling of what you're saying the real number is. Would you just say, oh, okay, well, I guess I'll just kind of go along with what you say. And I just must be living in some fantasy land. But in the fantasy land, you like to eat, you like to drive, you like to buy clothes and insurance products and service your daily standard of living. And it's not at the official CPI number stated rate of inflation. So that is what I mean by harass the public by, if anything, I would call it misleading at best. And at worst, I would call it flat out fabrication.
Could we call it theft?
Oh, yeah, absolutely.
Okay, so when you say harass, what you're really referring to is flat out theft.
Correct. Well, it's a inflation is a silent form of taxation. If we look at an ounce of gold in 1933 when it was confiscated, and you got your $20 for your double gold eagle, your St. Gaudens or Liberty $20 gold piece, and you had your $20 in cash, and you save that all throughout history, and you pull it out of your drawer almost 100 years later, and it's like, oh, here's my $20. You got $20. If you had saved in the $20 gold piece, you'd be sitting at about $5K. That's the difference.
So who's doing the thieving?
Well,
Like, at what point is the decision made where theft is the consequence? Because there's many, like, there's some piping to get to that point. You know, there's a lot of linkage that, you know, we could talk about, because it is theft, and it is something that people choose. There are actions that people choose that ultimately end up in this theft. So let's talk about, you know, tell us where do you see the inception of point of that? Or do you want to like walk us back a little bit?
well, my thought is that we're in a system that I would call the greatest experiment, one of the greatest experiments in recorded human history. The post-August 1971 world, where gold is no longer a form of money. We've had that disconnect. It happened. And now we have to continually and perpetually debase and print to keep the show going. That's it. It's the only way forward, or it all collapses in into a nice little pile of dust.
So that was the initial precipice where it's like we've set the theft of inflation out of the where we've embedded it into the structure.
Correct.
Yeah. So we all tolerate it. When do you remember first thinking, wow, our government and our policymakers and our monetary policymakers are absolutely flat out telling us that their target is to steal 2% of our money every single year on purpose.
Right.
When did you, like, for you personally, when do you remember like having that realization?
Probably sometime very early after the 2008 financial crisis, right around the time that I started finding interest in gold and silver, and kind of started my career in the space. And it's very shocking, Charlie. And so most people wouldn't realize, why would we have this intentional 2% debasement? That's just the stated target. What it really is likely a lot more. And we've said many times on this show, if we calculate inflation the way it used to be calculated, we are nowhere near what the official CPI stated rate of inflation is. And I don't know about you, but it's pretty gosh darn obvious to see it's not the CPI stated rate of inflation every month.
Okay, so it was the Bretton Woods, it was post World War II, it was a new world order. We have the dollar as the world's reserve currency, and as a consequence of that structure, we involuntarily are taxed 2% a year. And why is it that very few people know about this, Kyle? Why wouldn't everyone in the United States teach their kids about this from day one? Hey, everybody, come around the dinner table. We're going to talk about how from now until the end of time, our current monetary system is set up such that every dollar that you make from here on out, the stated goal is 2% we're going to take from you. And you don't even have to give it to us. We're just going to do it by inflating all the goods and services around us.
Correct. Yep. And so we are starting to see evidence of this train of thought we've talked about this a lot too. It's really important to just kind of bring this up again. The 60-40 portfolio is slowly having a nail driven through its coffin. We are no longer talking about portfolios constructed simply of stocks and bonds. We're talking about portfolios constructed of up to 20% of alternative investments, like gold, like real estate, God forbid some crypto maybe. Something that is diversified enough to where it doesn't have that correlation coefficient that we're seeing what should be, there should be a negative correlation coefficient with stocks and bonds, but they're becoming more positively correlated as more time goes on. And then, of course, we just mentioned in 2022, we saw a very interesting moment of time where both stocks and bonds fell together during that bear market going up to about October. That was the first time that had happened since 1932, that stocks and bonds both fell together. Very rare kind of circumstance, and we're starting to see more of that kind of negative correlation coefficient today.
Okay, so we've kind of talked a little bit about how we got here and where we're at, and where do we go from here, Kyle? Like I asked the same question. We talk about it just about every time. Where are we at? Where are we going?
Well, people are buying gold. People are buying silver. People are taking a stance here, and it's amazing for me to see as someone who's at the helm of Bullion Standard, who kind of gets to experience this stuff on a day-to-day basis.
Not kind of.
Yeah,
you absolutely are in the trenches.
That's what people are doing about it. They're planting a flag and they're saying, "I'm out. I'm out. I'm buying gold, and I'm buying silver, and I'm buying platinum, and I'm buying palladium. I'm buying alternative investments that have real value outside of something that can be counterfeited out of thin air."
So what's your 1 to 3 month and 1 to 3 year outlooks from here? We've had a really huge bout of inflation through COVID. We've had this massive run up in precious metals nominal pricing. We've had a lot of volatility, and price action is going up and down more than it has historically. I mean, in the last decade, 2 decades. And so we've got some intense volatility. How do you see this playing out over the next 3 months and then 3 years?
Well, we had a bit of news today, actually, out of Russia or the Kremlin or Putin or all three, that says something like Russia is now talking about some kind of economic package where it wants to have more strengthened ties to the U.S.
That makes me very happy.
That is the first shot of stability that I remember going back about a year, where it's just been nothing but chaos and all of the conditions that would be hostile for stability, positive for precious metals. I don't know if that's why we saw a bit of a sell-off today. Obviously today is Thursday, and gold and silver are down pretty big today. Silver has got down to like 75. I think it's like 77 right now. Gold sold off big. Everything just kind of got whacked. But it is an interesting dynamic now that we've had this hockey stick up for silver and gold. Just to recap, silver peaked at about $120 an ounce a few weeks ago. Gold peaked at about $5,600 an ounce a few weeks ago. My thoughts, literally, that Sunday before the market opened and silver fell like 30% or whatever it was that it just ran up way too hot, way too fast. And I don't mean that to be discouraging, like I'm a bear on silver or I don't have no more conviction for silver, but I have learned very adamantly over time that things that just go up straight like this usually come down a little bit too after that and cool off a bit. I couldn't see silver just continuing just a moonshot. It would be so unprecedented if it really continued to do that. Will silver be higher at the end of this year? Yeah, I think so. Will silver be higher in 3 years from now? Yeah, I think so.
Okay.
But
so we've got U.S.-Russia relations getting more stable. Maybe they're going to end the war in Ukraine, and they're going to figure that out, and we'll have some sort of connection, reconnection between Russia and the U.S., which is going to be pretty stabilizing. We'd like to think it'd be pretty stabilizing. And then so gold goes down, silver goes down, and for how long?
Until volatility returns. But what we need to remember is the trend to me seems like we've moved from globalism to nationalism. We're moving from that theme of we're one big giant community to every man for himself. And I've really felt that in the last few years, even from going back to the very early 2010s.
Well, this is the nature of the fourth turning. This is the nature of, the big resets that happen on such a reliable cycle.
Right. If the Russia-Ukraine war resolves itself and we get peace and some kind of ceasefire and things cool down, that will be the biggest short-term death blow for gold and silver I think we will experience in quite some time.
So if Russia and the U.S. create some monetary package, Russia now is going to buy $1 trillion of U.S. treasuries every year until we get through this fourth turning. What are we going to see there? I mean, are we still subject to the inflationary surges that are kind of baked into the cake right now? Therefore, we're still going to see, gold and silver and precious metals and hard assets rising in value, maybe real estate too.
This is exactly what we would want to clarify based on what we just started off talking at the beginning of this episode. There's only one way forward, Charlie.
Can we get a really nice animated, Kyle? Can you set us up with a really nice animated, free falling Jerome Powell?
Should we throw up the video of Jerome Powell actually driving over the cliff?
Yeah, let's get a really nice animated one going, and then as we move forward, we'll have all kinds of saviors coming in, floating in, trying to save, the falling car.
It's never gonna happen.
We'll have Putin and Trump come in, parachuting in, trying to pull the car back. They'll attach some ropes to it, and then the ropes will snap after they pull their parachute. Let's really have some fun with that.
Okay. So, yeah, Charlie, there's really only one way forward for this, and we'll call it Rick Rule's Math of America. I love that, by the way, the Math of America, because it's so desperately hopeless.
Yeah, I hear so many economists talk about the math doesn't lie.
That's why there's reliability over time with certainty. Unless something changes, I don't think anything's going to change. I think we're going to keep doing the same thing we've been doing since 1971. Why? Because we don't want to suffer the consequences. We're going to do what we know. We have an expectation that the future will be something reminiscent of what happens in our immediate past. And nobody wants to go through painful change. So there's reliability in gold and silver continuing to go up in time because there's only one way forward. We have to continually debase and print. And that's it. I would love to hear everybody's. Leave it up to the audience. If you have if you can answer this question, I'd love to know the answer to it. How do we get out of our $2 to $2.5 trillion per year deficit? Charlie, the floor is yours.
66 cents of every borrowed dollar going to pay the interest on it.
Oh, I have a great answer. We'll print more money. That's the answer. This is exactly what happened in the 1970s.
We can also raise taxes, but we did talk about, what happens when you raise taxes too high. People who are attached to money take their money to a place where the taxes aren't as high. So, that can only get us so far. And then obviously the last thing is cutting. I mean, that's probably not the last. I mean, cutting is not going to work. We've already talked about all the reasons why. Taxing isn't going to work. So the last resort is the print.
Correct. So I don't really know how we get ourselves out of this other than we're just broken clocks over here ad nauseum repeating ourselves. You own a little bit of gold and
Why
silver.
are we repeating ourselves? Because Kyle, no one, when we were at a very young age, sitting around the dinner table, no one told us. No one told us about money. No one told us what it is. No one told us that we're guaranteed, not guaranteed. There's no guarantee, but our policymakers, the people in charge, have stated that they're absolutely trying to take 2% of your hard-earned labor every single year. And so, I didn't know that until within the last decade, actually. And I'm still learning the dynamics of it all, and I'm still trying to put all the pieces together and say, well, what's actually happening here? It's really fascinating.
Yep.
I think the human behavior explains a lot of it. I think the explanations of why we do what we do, and then you can apply that, to economy and to monetary policy. And, when you know that you've got people that come into government and they're there for a short period of time, they're likely not going to do the best thing for the masses. They're probably going to do the best thing for themselves. They might want to do the best thing for the masses, but they're still a human being and they're still governed by their biology and their DNA and how they view the world. And so it's pretty reliable, all these structures, and especially the human behavior structure.
Right. So I want to talk about one of the things we'll wrap up here with is the 2026 revelation, I'll say. Okay. 2026 revelation. This year in 2026, it's becoming more apparent that we will have to have this reality check around the math of America. I don't know at what point and how many years we can just keep running by. And I'll give some context. I remember saying in 2012, when I was operating as a local dealer here, one of the big headline things was, the U.S. national debt is $17 trillion. Buy some gold and silver. Like, it's like, does anybody realize the behemoth gargantuan nature of this number? Like, that's really scary. How are we ever going to get out of that? Then it got swept under the rug and inflation stayed cool that decade. Now it's getting to the point where it's like, yeah, we might have to really think about when that crossover point of all federal gross receipts goes to pay the interest on our debt. And we're stuck between this rock and a hard place, as we've said, where we can't raise interest rates to combat any future bout of inflation. We cannot do it. Otherwise, well, you recall what just happened in 2022. We got a nasty bear market. And, we took interest rates up really high, kind of cooled things off a bit from all the COVID stimulus. And then we started to taper off. If we get a real serious inflation problem, we're done. There's no getting out of that. We could try to fix it, but if you try to raise interest rates into debt as 130% of your gross domestic product, you don't have the runway to be able to pull that off like we pulled it off when Paul Volcker came in and the Reagan administration, and the country collectively put their foot down and said, we cannot keep stealing from our grandchildren's future here with this outrageous, out of control inflation. So I'm going to I'll kind of wrap up here by talking about, I have a very strong belief that a second wave of inflation will be a very popular theme, Charlie, going into the second half of this year and into 2027. I think inflation runs in waves. I think as more time goes on, the peak trough nature of markets in a fiat system like the US dollar, and every currency, by the way, we're all in the same boat. This is why Doug Casey would call the dollar the cleanest dirty shirt in the laundry basket or something like that. All these analogies. But
well, it's interesting. So we'll see what AI does. That's kind of a black swan. We'll see what robots do. That's kind of a black swan potential. It's not necessarily a black swan because we can see it coming, but what's the consequences that we don't yet see from AI and robots? There's a lot of unknown there. But let's just say that we have some really great efficiencies in production. Are we going to be able to grow out of GDP is going to grow our way out of 66 cents of every dollar borrowed goes to pay the interest? I don't know. So if we have inflation, what's going to be the cause? The money printer? The money printer is going to fire up.
A $2.5 trillion deficit will be the cause. Where's that money coming from?
Okay, right. So where are we going to get the money to service it?
Well, the Treasury issues bills, notes, bonds, sends them off to the Fed.
Fed prints up some money,
counterfeits up some bills.
So that's
sends some money back to the Treasury.
Right. So inflation.
Correct.
And so when are we gonna? It's really interesting because we're going to have inflation in 2027, maybe 2028, maybe 2029. When does that actually, line up with something that's called the fourth turning in the cycle?
That's right.
It's lining up exactly right.
Yeah. And
so we're going to have all this inflation. Half the people in the country that are making, I think you had talked about on a last episode, like $36,000 is the median income.
last year, 2 years ago, is 39,000 is the median.
When you go through a heavy bout of inflation and you're making $36,000 a year, how are you supposed to eat?
That's right.
So this
is what happened.
That's the fourth turning. It's like that's when people are going to be like, we got to have a change here. Civil war, external hot war. Makes sense to me. I sure hope that we find a solution to peacefully get through this fourth turning. Wouldn't that be fantastic?
Well, we talked about when was the last fourth turning on the Capitalism podcast with Danny, and he asked, when was the last fourth turning, Charlie? And I think you said World War II.
World War I, World War II. I think it was World War I was the timing of it, but like right in that period.
Yeah. And then so I do wonder if that's the case, what was the 1970s when people couldn't afford to eat or get their food because it had just skyrocketed so much?
Well, we didn't have a changing world order in the 70s.
That's right.
So it wasn't a...
Well, no, we did have a changing world order in the 70s, Charlie. Gold became disconnected from the dollar for the first time ever.
Yeah, but it didn't become the world's reserve currency.
Right, that happened in 1944.
We didn't have a cycling of a world power where it went from number 1 down to number 4 or number 10.
Right. So, all right, Rick, if you're out there watching, thank you for following me on X. I appreciate it. Thank you for letting me riff on some of your points. Charlie, would you like to say anything at all? This is your opportunity.
Yeah, I got a lot of stuff to say, but I think I'll hold it in this time. But yeah, I mean, at the end of the day, like we've got some volatility in the gold and silver market. We're going to have some volatility, in our institutions and in around the globe more than we have. That's gonna, potentially lead to a transformational reset, and who's the world power and who's the dominant currency. And then so there's just one thing to do: take really good care of yourself. Just do the best you can to find the positive and the negative, and forgive and have some grace for everyone, and find a way to move forward where you're having some fun and joy inserted into your daily routines, and eat well, sleep well, get your exercise in, and buy a little gold and silver, for crying out loud.
Amen, Charlie. All right, go ahead and sign us off.
Okay, so remember, every ounce matters, and so does every insight. Remember to stay informed, stay committed to growth, and hold your Bullion Standard high.